Good afternoon. I want to welcome everyone to this virtual Brookings event. My name is Stephanie Aronson. I'm the Vice President and Director of the Economic Studies program here at Brookings. Thank you for joining us for today's event, organized by our Hutchins Center on Fiscal and Monetary Policy, on how the Fed will respond to the COVID-19 recession in an era of low rates and low inflation. The topic is particularly salient since last week, following an 18th-month review of its monetary policy strategy, the Federal Open Market Committee released a revised version of its longer-run goals and monetary policy strategy. We are honored to have Governor Lael Brainard of the Federal Reserve Board of Governors here to offer her thoughts on the topic. After we hear from Governor Brainard, there will be time for question and answers from the audience, and then we'll convene a panel to discuss the new Fed framework with Ben Bernanke, Janet Yellen, and two market Fed watchers, Roberto Perli of Cornerstone Macro and Julia Coronado of Macro Policy Perspectives. There will be more on that from David Wessel later in the program. In terms of logistics, if you would like to pose a question to Lael and to the panel, you can do so via email at events@brookings.edu. Now, before we begin, let me provide just a short introduction to Governor Brainard, who has had a long career of public service and in academia. Governor Brainard took office as a member of the Fed's Board of Governors in June 2014. Before that, she served as Undersecretary of the U.S. Department of the Treasury from 2010 to 2013 and counselor to the Secretary of the Treasury in 2009. I had the opportunity to have worked with Governor Brainard both at the Federal Reserve and at the Treasury, and can say that we are lucky to have someone in these roles who brings such remarkable intelligence and dedication to her work. I also can't resist mentioning that from 2001 to 2008, Governor Brainard was here at Brookings, where she was a vice president and the founding director of the Global Economy and Development Program, a program dedicated to addressing global economic challenges that is still going strong today. So with that short introduction and our appreciation, I will now turn the Zoom mic over to Governor Brainard.
Well, thank you very much, Stephanie, for that very kind introduction. It's a pleasure to be at Brookings with you and with David Wessel. It's an honor to also be followed by Ben Bernanke and Janet Yellen, who of course pioneered the original statement, as well as Julia Coronado and Roberto Perli. And it's a real pleasure to discuss the new statement that was unanimously approved by the FOMC last week. By bringing our longer run goals and strategy into alignment with key longer run changes in the economy, the new statement will strengthen our support for the economy. The new statement breaks important ground and will serve the country well as we respond to the economic repercussions of COVID-19. There were three related features of the economy's new normal that called for this reassessment. First, the equilibrium interest rate has fallen to low levels, which implies a large decline in how much we can cut interest rates in order to support the economy. That was abundantly clear in March when we were able to cut the policy rate by only 1.5 percentage points before hitting the effective lower bound, in contrast to previous decades when the policy rate would have been cut by 4.5 to 5 percentage points. The reduced scope to cut the interest rate could increase the frequency and duration of periods when the policy rate is pinned close to zero, unemployment is elevated, and inflation is below target. This in turn risks eroding inflation expectations and further compressing the scope for cutting interest rates. The risk is a downward spiral where the scope for cutting the rate gets compressed even further, the lower bound binds even more frequently, and it gets harder and harder to move inflation expectations and inflation back up to target, as we've seen in some foreign jurisdictions. Second, underlying trend inflation appears to be somewhat below the committee's 2% objectives, according to various statistical filters. The near decade of inflation persistently short of 2% creates the risk that households and businesses could come to expect inflation to run persistently below target and change their behavior in a way that fulfills that expectation. And that in turn greatly complicates the task of monetary policy. While it's hard to measure inflation expectations with precision, some market-based and survey-based indicators show signs of a downward drift. So it's critically important to ensure that long-term inflation expectations are well anchored at 2% to achieve our price stability goal. And finally, the sensitivity of price inflation to labor market tightness is very low relative to earlier decades. That's what economists mean when they talk about a flat Phillips curve. A flat Phillips curve has some important advantages. It allows employment to continue expanding for longer without generating inflationary pressures, which provides job opportunities to people that might not otherwise have had them. But it also means it's harder to achieve our 2% inflation objective on a sustained basis. In response, the new statement on goals and strategy makes 4 important changes. First, the statement defines the statutory maximum level of employment as a broad-based and inclusive goal and eliminates the reference to a numerical estimate of the longer run normal rate. The presumption that accommodation should be reduced preemptively when the unemployment rate nears the neutral rate in anticipation of inflation that's unlikely to materialize risks an unwarranted loss of opportunity. Instead, the decision to allow the labor market to continue healing after the unemployment reached the 5% median SEP estimate of the neutral rate in the fourth quarter of 2015 supported a further decrease of 3.5 percentage points in the Black unemployment rate and of 2.25 percentage points in the Hispanic unemployment rate, as well as an increase of nearly 3 percentage points in the labor force participation rate of prime age women. It also created conditions for the entry of a further 3.5 million prime age Americans into the labor force. Beyond that, it had the changes that we are making in the new statement been in place several years, it's likely that accommodation would have been reduced even later, and the gains would have been greater. The new commitment to defining maximum employment as a broad-based and inclusive goal, together with our continuing commitment to consider a wide range of indicators, may be particularly significant for the groups that are most vulnerable to employment fluctuations. Both research and experience suggest the groups that face the greatest structural challenges in the labor market are likely to be the first to experience layoffs during downturns and the last to experience employment gains during recoveries. Unemployment rates, as well as patterns of job loss and labor force entry and exit, are more cyclically sensitive for Blacks and Hispanics than for whites, and observable characteristics explain very little of those differentials. That was one of the key takeaways also from the Fed Listens sessions we held. For example, Juan Salgado, chancellor of the City Colleges of Chicago, described how last year's tight labor market was finally giving his students, who are largely Black and Latinx, the opportunity to apprentice with local businesses and jobs that might not historically have been open. Moreover, earnings from wages are particularly important for these groups who have large and persistent wealth gaps and derive a smaller share of their income from financial asset holdings or business ownership. Second, to address the downward bias to inflation associated with the proximity to the effective lower bound, the statement adopts a flexible inflation averaging strategy that seeks to achieve inflation that averages 2% over time. Flexible average inflation targeting, we could call it FATE, is a consequential change in strategy. By committing to seek inflation that averages 2% over time, FAIT or FATE means that appropriate monetary policy would aim to achieve inflation moderately above 2% for a time to compensate for a period, such as the last several years, when it's been persistently below 2%. Consistent with this, I would expect the committee to accommodate rather than offset inflationary pressures moderately above 2% in a process of opportunistic reflation. Flexible average inflation targeting is a pragmatic way to implement a makeup strategy, which is essential to arrest any downward drift in inflation expectations. While a formal average inflation target, AIT or rule, is appealing in theory, there are likely to be communications and implementations challenges in practice relative to the mechanical nature of such rules. In contrast, FAIT, flexible average inflation targeting, is better suited for the highly uncertain and dynamic environment in which policymaking takes place. That said, I see the commitment to undertake a review of the new strategy and goals in roughly 5 years as a necessary complement to the flexibility embedded in that new inflation averaging strategy. Since FAIT is a new approach, it's prudent and pragmatic to review it after gaining some practical experience with it over 5 years, as well as to get some insights into an appropriate makeup period. Third, the statement highlights an important change in the committee's reaction function. Whereas previously it sought to mitigate deviations of employment and inflation from their targets in either direction, the committee will now seek to mitigate shortfalls of employment from the committee's assessment of its maximum level. This change implies that the committee effectively will seek to minimize the welfare costs of shortfalls of employment from its maximum and not preemptively withdraw support based on a historically steeper Phillips curve that is not currently in evidence, and inflation that is correspondingly much less likely to materialize at high levels. Consistent with this, the statement drops language about a balanced approach that might be interpreted as calling for such preemptive withdrawal. And fourth and finally, the statement codifies the key lesson from the global financial crisis that financial stability is necessary for the achievement of our statutory goals of maximum employment and price stability. The changes in the macroeconomic environment that prompted our monetary policy review also have important implications for financial stability. Historically, with a steeper Phillips curve, inflation tended to arise as the economy heated up, which would prompt the Federal Reserve to raise interest rates to restrictive levels, which would tighten financial conditions more broadly. In contrast, we didn't see that in the past few cycles. In each case, financial imbalances rather than goods and services inflation were notably elevated at the onset of the downturn. In the new normal, the committee may have to sustain the federal funds rate below the neutral rate for much longer in order to push inflation back to target sustainably. The resulting expectation of lower for longer interest rates, along with high levels of resource utilization over a sustained period, is conducive to increasing risk appetite, reach for yield behavior, and incentives for leverage. In this way, the combination of a low neutral rate, a flat Phillips curve, and low inflation can lead to more cyclical volatility in asset prices. That's why it's vital to use macroprudential as well as standard prudential tools as the first line of defense in order to allow monetary policy to remain focused on achieving maximum employment and 2% average inflation. With these changes, the committee's new statement puts us in a stronger position to support a full and timely recovery in employment and average inflation of 2%. Overall financial conditions are supportive. Encouragingly, the housing sector has rebounded strongly from its initial decline, supported by historically low mortgage rates, and consumer spending on goods has held up well, in part reflecting earlier fiscal support. At the same time, the strong pace of improvement in employment in May and June, which was importantly driven by recall hiring out of temporary layoffs, appears to have slowed. And on the inflation front, despite some bounce back in July, inflation remains weaker than pre-crisis, and it's likely to take some time to return closer to target. Looking ahead, the economy continues to face considerable uncertainty associated with COVID-19, and risks are tilted to the downside. The longer COVID-related uncertainty persists, the greater the risk of shuttered businesses and permanent layoffs in some sectors. While the virus remains the most important factor, the magnitude and timing of further fiscal support is a key factor for the outlook. As was true in the first phase of the crisis, fiscal support will remain essential to supporting many families and businesses. With the recovery likely to face COVID-related headwinds for some time, in coming months, it will be important for monetary policy to shift from stabilization to accommodation. And as we move to the next phase of monetary policy, we'll be guided by the committee's new goals and strategy statement. It will be important to provide the requisite accommodation to mitigate the shortfall of employment from its maximum and to achieve inflation that averages 2% over time following persistent underperformance. The new consensus statement will frame the committee's policy deliberations. Let me conclude by expressing appreciation for Chair Powell and Vice Chair Clarida in leading this review, as well as important contributions by President Williams and by Ellen Mead and Thomas Laubach, as well as Jeff Fuhrer, Mark Giannoni, and David Altig. Our deliberations were greatly enriched by engagement with community members through Fed Listens events in every district of the country, as well as outstanding memos by staff and papers and responses by leading outside experts. While the committee didn't anticipate the unprecedented challenges of the COVID-19 pandemic, when the review was launched, the new statement puts us in a stronger position to support the economy. Thank you.
Thank you very much, Governor Brainard, for that very clear and succinct statement. We have a number of reporters online who have emailed questions, and people in others have watching can send questions to events@brookings.edu, and quite a few of them have already. So I'm going to borrow from their questions, in some cases paraphrasing them. I'm not sure I'm going to attribute everything to everybody, but to start off, Governor Brainard, you said something I think people may have missed because it went by pretty quickly about what difference would it have made had this statement been in place earlier. You said that it is likely accommodation would have been withdrawn later and the gains in employment, thus, particularly for minorities, would have been greater. So the Fed raised interest rates 10 times over 2015, 16, 17, and 18. It raised interest rates a full percentage point in 2018, 4 times. Are you saying that had this statement been in place, those rate increases would not have occurred?
So it is, I think, important to note that these are consequential changes to our strategy and to our goals. Whereas previously we were seeking to mitigate deviations of both employment and inflation, we are now very focused with regard to employment only on shortfalls. Whereas previously we talked about the goal on employment in a way that was roughly associated with the normal rate of unemployment, the statement no longer references that and talks about a broad-based and inclusive goal and a variety of indicators to assess it. And the statement also talks about a inflation goal that is defined in terms of average inflation at 2% over time, which means that inflation is likely to need to moderately exceed the 2% target for some time following periods when it has been below that target. Those changes would have materially changed the conversations among the committee, certainly back in the early 2015, 16, 17, maybe into 18 period. There, I think, would have been a different concept of inflation and a sense that there was no need to preemptively withdraw or prepare to withdraw on the basis of an expectation of inflation materializing on the basis of historical relationships. And there would have been a recognition that there's a downward bias associated with that effective lower bound. So yes, I think these are consequential changes. They will change the way the committee deliberates going forward. They would have changed deliberations earlier in the period had all of these factors been well understood.
Right, so just so I can paraphrase that and make sure I understand. So in the past, when it looked like the unemployment rate was falling below the normal rate, the NAIRU, the non-inflationary rate of unemployment, when it was getting close to that, that became an argument for raising rates. And similarly, when inflation began to get close to 2%, that became an argument for raising rates. In future deliberations, that will not be an argument easy to make given the new strategy.
I think that's, you summarized it much better than I could, David.
Okay, so I think you anticipated, or you've probably heard people said, oh, this is great. Flexible average inflation targeting, it means whatever the Fed wants it to mean and no one else will know what they're talking about. There's no sense of how much above 2% you're interested in inflation going. There's no sense about over what time you'll be averaging inflation. Why did you decide to make it so vague? And is this something that you think will be refined as statements come out about current policy?
Yeah. So those are really good questions. Those are questions that you know from the minutes. The committee debated at length. We had some excellent staff papers and some excellent outside papers to help inform those deliberations. And you know, this is a kind of canonical trade-off in monetary policy, right? The trade-off between a mechanical mathematical formula and the ability to adapt to ongoing realities is a long-standing discussion in monetary policy. It seems important, particularly important, to err on the side of pragmatism at a time when we're embarking on what is essentially a new approach. So I see FAIT, flexible average inflation targeting, as a pragmatic way to implement a makeup strategy. While a formal AIT rule is appealing in theory, there are likely to be communications and implementation challenges in practice related to the mechanical nature of such rules, and we talked about those challenges. FAIT is better suited for the uncertain and dynamic context in which policymaking takes place, and it will allow for some learning over time. I do want to just be clear, I find it very instructive to use formal rules as benchmarks to help inform my thinking about the appropriate path of policy, and I will be looking at a variety of different ways of thinking about this. But since FAIT is a new approach, it's prudent and pragmatic to review it after gaining some practical experience with it. And that is, in my mind, one of the great values of the 5-year review, which is kind of a natural complement to the flexibility in the approach we're adopting.
Would it be correct for people to assume, because of this new statement, that the current committee believes that when there's been a persistent undershoot of inflation, as we've seen, that you're basically making a commitment not to raise rates until inflation has at least met or even exceeded the 2% target?
So that is something I really can't sort of speak or prejudge how the committee might interpret that. Individual members will think about it differently, but we have all said in that statement that it's likely that appropriate monetary policy would seek to have inflation moderately above target for some time after a period of being below it for some time. That, to me, is what that statement implies. And in my own thinking, that will be an important consideration. Of course, we'll be looking at a whole variety of developments, including information on inflation expectations, but that is the simple meaning, I think, or implication of that kind of approach.
Can you achieve the goals of full employment and price stability without substantial increase in fiscal stimulus?
So in terms of the particular circumstances that we face today, and I touched on this earlier, there's a lot of uncertainty that continues to cloud the outlook. Downside risks continue to be important. I have been pleased by some of the recent data on consumer spending, and of course it's good, very good to see people going back to work. But we don't know whether that pace of improvement on the labor market's going to be maintained at the same rate. And it is very important to many households and businesses to have continued fiscal support, just as it was important to them in the early phase of this crisis. While the COVID uncertainty is the single most important uncertainty, fiscal is, in my mind, a very important factor.
You don't want to put a number on that, do you?
Thank you. I'll leave that to somebody who is actually working in that realm.
You mentioned, and the statement does as well, really elevating, I think, financial stability to a new prominence in the Fed's long-run goals. I've been around long enough to remember when asset prices were something that someone else should worry about. And Alan Greenspan once said something about irrational exuberance. The market flinched for a bit, ignored him, and that was the end of financial stability considerations. Ben Bernanke established a new division of financial stability at the Fed, of course, for good reasons, after what we went through in 2008 and 9 with our colleague Nellie Lang being the first director. The new statement says that the committee's policy decisions reflect its longer run goals, its medium-term outlook, and assessment of the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. And you referred to that a little bit in your remarks, but I want to give you a chance to expand on that. So two pieces. One is, right now, do you think that the macroprudential tools and the regulators are doing enough to contain the risks of financial stability, given how low interest rates are and are likely to be? And secondly, are you suggesting that in the future, the statement will give the FOMC reason to raise interest rates if they think that there's risk of financial instability, perhaps an asset bubble?
Yeah, so let me take those maybe in reverse order, but you're highlighting what is important and maybe is unlikely to receive as much attention. It is an important change that the new statement recognizes that financial stability is necessary to the achievement of maximum employment and price stability. That's a change, and it's important recognition. And in my mind, it is an evolution. It does necessarily flow from those same changes in the macroeconomic environment. That combination of a low neutral rate, a flat Phillips curve, and low inflation can lead to more cyclical volatility in asset prices. And we know that in the last few cycles, I'll put apart, setting aside, obviously, COVID is entirely different, but financial imbalances rather than goods and services inflation were notably elevated. So that possible long period where market participants could expect low for long interest rates, along with sustained high rates of resource utilization. Those are circumstances in which you do tend to see risk appetite, reach for yield behavior, and incentives for leverage. So since the creation of the Division of Financial Stability, we have put important changes in place. Importantly, we do have the benefit now of having developed a rigorous framework for monitoring the buildup of financial vulnerabilities, which Nellie is familiar with and was very important in designing. And that is shared with the board and the FOMC on a quarterly basis and published semi-annually in our financial stability report. And it is going to be an important consideration. It will continue to be. I think the important additional consideration, though, to speak directly to your question, is it's very important to see the board's active deployment of macroprudential as well as standard prudential tools as the first line of defense in order to allow monetary policy to do the work it needs to do on achieving maximum employment and 2% average inflation. So with regard to where we are today, I think it's extremely important in the supervised banking sector. Those buffers that were built up since the financial crisis served us exceedingly well. As we went into the COVID crisis, banks were able to continue lending. They were a source of strength. I don't think they should be paying out dividends. I think they should be hanging on to their buffers and continuing to lend. And of course, the important risks that need to continue to develop macroprudential and prudential frameworks around are also in the non-bank area, as we saw again in this crisis. So that macroprudential and prudential set of tools continue to be, in my view, the first line of defense.
But if the macroprudential tools don't suffice, or as you've dissented a number of times, the rest of the board has not been willing to, for instance, raise the countercyclical capital buffer, should we anticipate a time when the Fed will raise interest rates and give as a reason financial stability concerns as opposed to the more conventional inflation and unemployment concerns?
I do believe that financial stability considerations, rising imbalances have been and will continue to be important parts of our committee discussions. Again, we have a session devoted to that every quarter, and they come into all of our outlook discussions or policy discussions. For me, the hope is that we can really rely on strong macroprudential and prudential tools to deal with those. I think we got a lot of authorities under Dodd-Frank, and it's very important for us to use them for precisely that reason.
One of our colleagues asks if you can discuss any implications of the new framework on foreign demand for U.S. securities and for exchange rates.
Well, I certainly think that the transparency of our monetary policy framework and the very important evolution in it should continue to be critical pieces of the transparency and deep liquidity and other characteristics of U.S. Financial markets that have been very important to foreign investors. I think it's also very important that the committee was prepared to act very forcefully, very quickly, to deploy all its tools when the COVID-19 crisis struck. As you know, not only did we engage in an important set of interventions to restore smooth market functioning in our own markets, but we also worked with partners to reinstate swap facilities. We made those terms more attractive and more suited to current circumstances. And we innovated a very important new FEMA repo facility. And I think those actions as well as the kind of clarity and transparency around our framework are some of the important reasons that foreign investors continue to look to U.S. financial markets as dependable and highly liquid.
It seems to me that I think Governor Clarida made this point yesterday that the decline in the interest rates is global. The natural rate of interest decline is global. So presumably that should mean that this shouldn't put us out of whack with other countries. So I think the concern is by signaling an easy monetary policy, are you putting the value of the dollar at risk here?
So I think that these trends that I talked about is motivating our framework. The low neutral rate, all of the research and all the experience suggests this is really a global phenomenon, particularly affecting advanced economies. Many advanced economies are grappling with low inflation. And I would say many economies also, the ones that I spend the most time exchanging views with, also see this phenomenon of a very flat Phillips curve. So you're right, in that sense, a lot of peer foreign central banks, as well as we here in the U.S., are grappling with a similar set of challenges and coming up with somewhat different responses to them, but all motivated by those same forces.
So are you confident that you have the monetary tools to achieve the goals that you've set forward in this statement?
So I would say that we have a robust set of monetary policy tools. And of course, the statement does make a strong commitment to use all available tools. I'd say that is in fact, a hallmark of our response to COVID to date. That said, of course, the statement is focused on our longer term goals and strategies. Forward guidance, as well as asset purchases, were extensively tested in the last crisis, and there's a high degree of familiarity with them. So they remain at the core of our response. I think the committee's consistently concluded that negative interest rates don't have an attractive cost benefit in the US context. And of course, it's clear from the minutes of our July meeting that yield curve targeting is certainly in the toolkit. And there could be circumstances where it would be considered to reinforce forward guidance, akin to what the Reserve Bank of Australia is doing. We're not thinking about deploying it right now, but it's certainly in the toolkit. And, I, as you know, and others on the committee believe it could potentially have a place as a complement to our other tools.
This comes from a reporter. In what ways would you suggest making forward guidance around interest rates more explicit in order to complement the changes in the reaction function? And are you thinking about ways to use forward guidance to make the framework more effective during this period when things are so unusual?
So, as was I think in the minutes from the July meeting, we did have discussions about potential ways that we might refine policy. Now that we've concluded the review, I would anticipate we would return to a discussion of appropriate monetary policy, and it is consequential in my mind that the new consensus statement will frame our policy deliberations as monetary policy pivots from stabilization to accommodation. The committee's discussion of policy at the next meeting and beyond will be framed by the goals and strategy that were agreed in the statement. I wouldn't prejudge the timing and nature of any conclusions, but as you know from minutes, forward guidance has come up in our conversations, and in some ways it's a natural way to extend conventional policy space. And we gained experience with threshold-based guidance under both Chair Bernanke and Chair Yellen, and so it would only be natural to discuss a full set of possible ways of taking forward our statement. But again, I can't prejudge those discussions or any conclusions.
But do you personally see tweaking the forward guidance to be more specific or threshold-based as a good idea?
So again, I think we've had conversations about it. I think we've had conversations about forward guidance in previous policy deliberations. Those discussions would be natural for us to turn back to them now that we have that framing from the statement. And so it would be natural, in my mind, to see those connected.
I see. Another reporter asks that given the emphasis on financial stability in the statement, will this affect how you think about the bank scenario analyses, which you're going to carry out as part of the stress testing process later this year? And how do you see that going?
So I think the stress tests are very important. I think that was true all through the last nearly 10 years now, and it's been particularly important in helping my thinking in assessing adequacy of buffers for various scenarios going forward. So I think they will be very important in my thinking about how important it is to retain buffers in order to be able to provide credit to the economy. And so I don't see that changing as a result of the statement. I see that as a continuing very high priority.
Governor Brainard, as you know, there's been quite a bit of focus on issues of racial equity in the United States, problems that, of course, predate the George Floyd and all the other police killings, but these have really come to the fore. And there are people that are asking, what can the Fed do? What should the Fed do? What are the limits of your authority? What are not the limits of your authority? And thinking about the great inequities between Black households and white households in terms of everything from employment to household wealth. Now, you mentioned in your statement that one argument is that the longer you allow the economy to run with low unemployment rates and you don't preemptively raise interest rates to prevent a decline in unemployment rate, that seems to have a favorable benefit on minorities. But is that the extent of what you think the Fed can and should do in this regard?
Yeah, it's a really important question. I believe that within the four corners of the statutory responsibilities given to us by Congress, our work at the Federal Reserve can and should help address racial inequities. That's very clearly evident in our responsibilities on fair lending, on the Community Reinvestment Act. It's evident in our responsibilities under the Dodd-Frank Act, and it's very important in our research and data collections. And I'll just highlight the distributional financial accounts and survey of consumer finances, which are probably the best data available now at a high frequency, quarterly frequency, on the distribution of wealth among different demographic groups. We have devoted a lot of time and attention in recent years to analyzing that data, income, wealth, employment disparities across racial and ethnic groups. That's been important in our FOMC deliberations. I'm happy to say that we are reporting on them in the Monetary Policy Report. And it is critical in assessing where the economy stands. It's also true that the research and experience that we have access to through our work, our staff work at the board, but also our outreach, very important through our extensive community development network, suggests the groups that face the greatest structural challenges in the labor market are also likely to be the first to experience layoffs during downturns and the last to experience employment gains during recoveries. And we see those patterns of greater cyclical sensitivity. And as I said earlier, observable worker characteristics don't actually explain those. So that's also a key takeaway from the Fed Listens session. So I do think the new commitment to defining maximum employment as a broad-based and inclusive goal, together with that commitment to consider a wide range of indicators and our commitment to focus on shortfalls, I think those things together are consequential in this area.
As you know, there's some people in Congress who think this should be added to the Fed's mandate. Do you think that's a good idea?
So I usually take very importantly the mandates that we receive from Congress, and it's important for Congress to make those determinations.
So as you know, sometimes people argue, look, the Fed doesn't want to admit it, but it's increasing inequality because all this asset buying, quantitative easing dries up the stock market. Most stock is held by wealthy people. The Fed is increasing inequality, and it doesn't acknowledge that. When people say that to you, and I'm sure you've heard it, what's your response?
So I think the changes in the statement are very significant. I really think it's important to take a little time to digest those. They have important implications for this issue in particular. They will enable the labor market to heal for a much more sustained period. And we know that that kind of sustained, strong labor market is the single most important factor that brings some of these structurally challenged groups back into the labor force, back into good employment opportunities, and creates opportunities for advancement. And we also know, related to what you said, that those wage earnings are going to be particularly important for those groups. And how do we know that? Because of data that we collect and that we make publicly available. So we're very attentive to it. I spent a lot of time on it. I think the statement is a big change.
But I think that what the people sometimes say is, look, if the Fed can't cut interest rates below zero, and it's going to have to rely on buying lots of bonds, that will push up asset prices. It's part of the design, and that inevitably will make inequality worse. You don't look at it that way?
I think that our framework is very clear. Our goal is to eliminate shortfalls from maximum employment, defined in broad-based and inclusive terms, and to get inflation back to 2% on an average level, which means a period of moderate overshooting. Those two things together themselves, I think, are the key goals. How we get there, that is going to be determined on a facts and circumstances basis. But the goals are very clear.
Mm-hmm. I wonder if you could elaborate a little bit more on how you see the economy right now. I recall that when you spoke about the economy in July, you were, I think, a little more pessimistic than the consensus. And unfortunately for us, you might have been right. I wish you hadn't been. But as you point out, it's a bit confusing now. On one hand, we see car sales have picked up. The housing market is benefiting from low mortgage rates. Consumer spending seems to have perked up or maintained itself. Is this just like the tail end of the fiscal stimulus and that we should anticipate things getting worse from here? How do we think about what's happening to small businesses and the 1 in 10 workers who are officially unemployed and the even more who are not working but not counted?
Yeah, those are the questions. You're right. Relative to when I spoke publicly in July, I have been encouraged by the strength of consumer spending. We saw robust good spending in both June and July, and it's now well above pre-crisis levels. We saw the housing sector post a strong rebound also in June and July, of course, supported by historically low mortgage rates. The data on business investment surprised to the upside, and financial conditions remain very supportive. But after seeing that strong pace of improvement in employment in May and June, pace of labor market improvement appears to have been slowed, according to some high frequency indicators. So I'll be watching that very carefully later this week. And of course, inflation, despite that bounce back, remains weaker than pre-crisis and is likely to take some time to return closer to target, let alone meet our goals. And as I look forward, it's a period of unusually elevated levels of uncertainty related to the pandemic, and in my mind, risks are tilted to the downside. So I do worry about the potential for permanent business closures and permanent layoffs and the kind of damage that'll do both at the individual level, but also to the productive potential of our economy. And fiscal support is a key factor in my own outlook. I think it will remain very important to many small businesses, to many families. So, it's a mixed outlook, better than it was, but still very high levels of uncertainty and with risks tilted to the downside.
I see. So the government, the Congress, the Treasury, and the Fed has done a number of things to support businesses to try and minimize the number that go under altogether. There was, of course, the Paycheck Protection Program, which was aimed at the smallest businesses, which, whatever its flaws, I don't think we can blame the Fed for those. There was the bond buying you did for firms that are big enough to issue bonds in the public markets. And then there's the Main Street Lending Program. And I'm just curious what you think about what we've learned about the Main Street Lending Program and how you respond to people who say it seems to have been rather ineffective, given that very few people have taken advantage of it. And these are not people who can turn to the market. So you're not supporting the markets I'm not supporting them by supporting the markets.
So I would say, you talked about many of our facilities. Also important is the municipal liquidity facility. We TALF. It remains important. We rolled out a number of facilities, in conjunction with Treasury and ultimately with the support of Congress. to address a whole variety of areas, some of which were familiar from the financial crisis, but we went we supported the Paycheck Protection Program by providing that discount window backstop to banks. And we did extend ourselves into Main Street. I thought that was important. I continue to think that's important. We also know how important states and localities are. And so our municipal liquidity facility is important there. Now, most of our facilities have a big effect by essentially being backstops. And that is true across the board. Most of them see very little usage, and that is actually a good sign. And so, if you look across the board at most of our programs, in one or two, you might have seen a period of usage, but then it drops off as market indicators return to more normal levels. I think Main Street is going to remain very important as an insurance policy. We don't know how the rest of the year is going to go, and we certainly don't know how COVID and the economic repercussions are going to look, in the fourth quarter. And having that insurance policy, I think, is very important. Banks have been very willing until recently to extend credit. And for some businesses, capital markets have reopened. And for, those that are on the kind of cusp between, issuance and going to banks, have done that. So I wouldn't look at any one particular facility and make a judgment. It's far too early. I'd look at them in totality. And are there things that I would do differently on each of them? Absolutely. I think we all individually have a sense of what we think would be appropriate, but that's okay. This is a partnership, and
partnership with the Treasury.
Yes,
yeah.
And I think standing up a facility to reach Main Street is a very important and new venture that the Fed has done for the first time.
So I understand your point that many of these are backstops. That is, when you announced that you were willing to buy municipal bonds or you provided the municipal liquidity facility, one could see the markets heal, and a number of state and local governments are able to borrow on public markets. And the same goes for people who can borrow on public markets at the corporate bond markets. But I'm not sure how I see Main Street as that kind of backstop. And I wonder whether on that particular facility, your preference would be to change the terms or not.
So I think, in part, it is a backstop in the sense that we hear from a lot of banks that they still want to be making those loans, that for good businesses that they know well, they still have confidence and they want to be making those loans. And that's a good thing. And so in that sense, yes, I do see it as a backstop. And they know that the program, they've registered for the program. They might have brought a few borrowers to the program in some cases. They know it's there if they don't want to commit their balance sheet in that way. So yes, I do. Now, is Main Street a little bit like for the lower end PPP? Yes, it is. And as you know, there's a grant element there, which Main Street doesn't have. I think it's a good discussion to have going forward, whether it makes sense to provide some more credit risk taking there under certain circumstances at the lower end potentially. I think that's a good debate to continue having.
I see. Now, predicting the future is a very hazardous occupation, and I don't think there were very many people, although I'm sure there's someone out there who will email me, who 18 months ago would have ever predicted where we would be today in terms of how the damage that COVID and the response has done to the economy and our difficulty in returning to normal. But that said, I'm just curious, looking down the road, how long do you think it'll be until we can say we've achieved your goals on price stability and employment? How long till we get back to the kind of full employment that we came close to before COVID and we get inflation up to 2% on average? Is it 2 years, 4 years, 6 years, the rest of my life?
So
My dad died at 98, so the rest of my life is a long time.
I was going to say, I hope that's a very long time. So, I can't offer you a better forecast than anybody else out there, probably worse at it. But I will say that's not how I think about policy. I really think about, a baseline and, some risks around it, some possible scenarios. The baseline looks a little better, but the risks do not. And so, I continue to think that it is, important for monetary policy to shift from stabilization to accommodation. We will have the first SEP that I believe incorporates 2023 coming out around the time, or we normally would around the time of the FOMC meeting. And so you'll be able to see how the committee is thinking about that time frame in terms of its goal. Now it's taken, inflation has been persistently below target, for on and off really close to a decade now, with some exceptions. And if the past is any guide, inflation moves more slowly. The employment trajectory tends to improve more quickly, and we've seen some really nice rehiring and temporary layoffs. So I'm continuing to hope that we'll see a sustained pace of improvement there on the labor market. But I think it's really important to stay the course on getting inflation to an average of 2% over time by seeing some overshooting.
I'm trying to understand what it means to go from stabilization to accommodation. This will be the last question. I mean, in some sense, it seems like the Fed has pulled out the stops. You've got interest rates at zero. You've told us they're going to remain there for quite a while. You've bought a lot of bonds. You've not tapered, at least not very much. So what more could you do that would move from stabilization to accommodative, which implies pushing growth up?
In my own thinking, it's really about the goals of our tools and what we are orienting the tools to. You're right that in the early months of COVID, market functioning was an extremely important focus of the design, speed, size of some of the things that we did. Now that we have this, I think, very consequential consensus statement agreed that will help us both think about the goals in terms of the way we've defined both maximum employment and inflation, and the reaction function to get us from here to there. So I think that reorientation of the goals is very important.
See, well, with that, we're out of time. I want to thank you for so much time giving us, and thank everybody who asked questions. And I tried to ask all the ones that were posed. If I missed one or two, let me know, and I'll see if I can get Governor Brainard to answer them later. I think what we'll do now, if my colleagues correct me if I'm wrong, take a brief break, and we'll be back with our panel with Ben Bernanke, Janet Yellen, Roberto Perli, and Julia Coronado. So thank you very much, Governor Brainard.
Thank you, David, and thanks to Stephanie as well.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.